Toronto area home sales increased by more than 9% in June, while the number of new listings dropped by almost 13%. But here's where things get interesting. Even with more homes selling and few newer listings coming onto the market, the average selling price was still down compared to last year. So, is the GTA real estate market recovering? Are buyers losing their negotiating power? And should homeowners who have been waiting finally consider selling? In this video, I'm gonna break down the June numbers, explain what they actually mean for buyers and sellers, and show you the part of the market that may be quietly creating opportunity. My name is O'Dane Harding, and I'm currently helping buyers and homeowners throughout Toronto, Scarborough, and Durham work through these exact decisions. If you're considering buying or selling and you want to avoid an expensive mistake, you can book a real estate clarity call with the link in the description. Now, let's take a look at what happened. According to the Toronto Regional Real Estate Board, 6,770 homes traded across the GTA in June of 2026. That represents a 9.4% increase compared to June of last year. And on a seasonally adjusted basis, sales also increased compared to the month before. Now that matters because it tells us that buyers are actually gradually becoming more active. At the beginning of 2026, a lot of buyers were still sitting on the sidelines. They were watching prices, interest rates. They were worried about the economy. And many were waiting for this giant bell to ring that signaled that this was the perfect time to buy. Unfortunately, that bell doesn't exist. What usually happens is that affordability usually improves quietly. Inventory begins to get absorbed, and then buyers slowly return. By the time the headlines confidently announce that the market has recovered, some of the best negotiating opportunities don't exist, and they're already gone. But rising sales doesn't mean that every house is getting 10 offers. This is where we need to look at the second number. There were 17,282 new listings in June, and that was down 12.9% compared to June of 2025. Active inventory also declined to approximately 27,329 properties, about 13.5% lower than a year ago. That leaves the GTA with roughly 4 months of inventory. And 4 months of inventory generally indicates a more balanced market. But the GTA is not one single market. A properly priced detached home in a desirable neighborhood might attract strong interest, while a dated condominium that has high maintenance fees might sit on the market for a few weeks, if not a few months. A townhouse in Pickering may behave differently compared to a downtown Toronto condo. And two homes on the very same street could have two different outcomes depending on the condition, presentation, and price strategy. This is why the headline, Toronto is a buyer's market, or Toronto is becoming a seller's market, is usually too broad to be useful. So yes, the market is becoming more active, but it remains extremely selective. Buyers are willing to purchase. They just aren't willing to overpay for everything. And that brings us to the number most people care about. The average GTA selling price in June was $1,058,658. That was approximately 3.9% lower than last June. The benchmark price was $940,800, which was down 5.4% compared to last June. Now the average price and the benchmark price measure different things. The average price can move depending on the different mixture of homes that were sold that month. For example, more expensive detached homes sell, the average can rise, even if the value of an individual property hasn't changed much. The benchmark is designed to track the value of a more typical home over time. But both measures are telling us something similar. Prices are still lower than where they were a year ago, even though buyer activity is improving. And the price declines were not equal across all property types. The average detached home price was approximately $1.36 million, down approximately 2% year over year. Semi-detached homes averaged $1.04 million, which was down about 4.7% year over year. Freehold townhouses averaged roughly $912,000, and that was down about 5.5%. And condo apartments averaged $631,000, which was down 9.4% compared to June of last year. The condo number deserves some attention. There's still considerable inventory. Investor demand has been weaker. Some buildings have high maintenance fees, and buyers have become far more selective when it comes to layouts, locations, and monthly carrying costs. And that creates risk for sellers. But it may also create opportunities for certain buyers. Don't get it twisted. I'm not trying to tell you that every inexpensive condo is a good deal, but first-time buyers who've been priced out of freehold homes may have more room to negotiate in the condo market than they've had in years. The key is to evaluate the entire monthly cost: mortgage payment, property taxes, maintenance fees, parking, insurance, potential special assessments, and the financial health of the condo corporation, because the sticker price alone could be a trap. For buyers, June's numbers are a warning against waiting for the perfect conditions. Prices are lower than last year. There's still meaningful inventory, and many sellers remain negotiable, but sales are increasing while the flow of new listings are decreasing. If that continues, buyers could gradually face more competition. And that doesn't mean you should rush out and buy a house this weekend, but it does mean that you should be prepared before the market forces you to rush. First, get properly pre-approved, just not a 5-minute online calculator. You need to understand your actual buying power, your estimated monthly payment, and how much cash you'll need for closing. Second, choose a realistic property type and location. You may want a detached home in Toronto, but your actual numbers might be pointing towards a townhouse in Pickering, Ajax, or Whitby. That's not necessarily settling. It just may be the first step to a longer real estate plan. Third, investigate the properties that have been sitting on the market. A home that's been sitting on the market for 30, 45, or 60 days may have more negotiating room than one that just came onto the market. Remember, everybody's looking at that brand new listing while the older ones go stale. Don't ignore that, but don't automatically assume that higher days on market automatically means desperation. The property may have problems, or the seller may be unrealistic, or the listing might have been terminated and relisting, hiding its true history. You need to examine the entire listing timeline. And finally, don't waive important protections just because market activity is increasing. Financing, inspection, and status certificate conditions exist for a reason. The objective is not just to win the property, it's to make the purchase that still feels good after the excitement wears off. And if you want straightforward advice when it comes to buying, selling, and understanding the usual hype, subscribe, because that's exactly what I cover. Now let's flip this around to sellers. Now you sellers, the increase in activity is encouraging. There are more buyers participating than there was a year ago, but this isn't a market where you can automatically choose an ambitious price, put up a sign, and wait for multiple offers to rescue the strategy. Buyers have access to information more than they ever have before. They're comparing your property with every competing listing. They're looking at previous sales, and because affordability still remains tight, they're extremely sensitive to price. The first mistake sellers need to avoid is pricing based on what a neighbor got back in 2022 or even early 2023. The sale occurred in a different market with a different inventory, different borrowing costs, and a different buyer psychology. The second mistake is assuming that every improvement adds back its full cost. You may have spent $80,000 renovating a property. Now that doesn't automatically mean that the market will pay an additional $80,000. Renovations can improve presentation and buyer appeal, but the final value still depends on location, layout, lot size, condition, and comparable sales. The third mistake is launching without a repositioning plan. Before listing, you should know what we're competing against, how many similar homes are available, how quickly they're selling, what have buyers rejected, and what we will change if the property doesn't receive the expected response. Pricing isn't just picking a number, it's a marketing strategy. And in this market, the best positioned homes can still attract strong activity, and poorly positioned homes can sit long enough to become stale. So, is the real estate market recovering? The honest answer is that it appears to be gaining traction, but we're not in a full seller-driven recovery. Sales increased, new listings decreased, inventory tightened, but prices remain below last year's levels. And that combination suggests that the market may be going through a transition. Buyers still have opportunities, especially in property types and neighborhoods that have high inventory. And sellers have more activity to work with, but they still need to earn the buyer's attention through proper pricing, preparation, and presentation. The biggest mistake would be making a decision based only on the GTA average. Your neighborhood, your property type, price range, and personal timeline matters far more than one headline. And if you're planning to buy or sell and want to understand what these numbers mean for your specific situation, you can book a real estate clarity call with the link in the description. Bye for now.